Hi, this is Shane with the Rational Trader. It's Sunday the 10th, so we're going to do our weekly review here. Let's take a quick look at results. Trade activity log. So since we started again here with the learnings from December and January, and what we're doing is trading all four markets now at more conservative risk levels. And so in 2 weeks, we're plus 140, which is essentially scratch once you factor in commissions. Look at the number of trades. It's a very reasonable number of trades. In fact, you might think it's not enough. 4 trades per day, 6, 5, 5, 5, 3, 2, 4, 1. And I'm reminded of sort of the difference between offense and defense. And so it was this analogy came to mind thinking about the recent Super Bowl, where in football, it's defense that gets you to the championship is sort of what they say. Defense wins championships. You need the offense to do something, but if you can't stop the opponent, then you can't win. It's very similar in trading, where with one key difference. If you have a defensive posture, then you can stay in the game. Whereas in trading, if you take too many losses, you have to stop. You stop playing. So that would be analogous to in a football game. You get down so many points, and then you just call the game. The game's over. It doesn't work that way in that kind of game. But in trading, we have to do that because we need to very carefully control our costs, manage our risk. So in December, we were, I wouldn't say aggressive, but we weren't conservative either. And then in January, we were very aggressive and struggled to turn a profit because we would take losses and then you're out of the game. And so what we're doing now is more conservative postures in all markets. And so the idea then is, stay in the game for when you get that good day. All right. Let's look at each market individually, and then we'll kind of segue into a couple of the things to chat about here. So let's look at, here's 6E. So 6E, really, you can see I just started this past, sort of midway through last week. Not doing much, just a handful of trades, down $25. The analysis shows it's worth trading. Looking at those results, you'd say, I don't agree. But 4 days is not enough. But we're going to talk about some expansion to the euro in just a minute here. The yen, here's a good example of what I just described, where you have this really good day. And the other days are basically you're playing defense. You're playing defense until you get that day. Play defense until you get this day. So plus 275. Oil, I think it's H now. So here's oil, plus 50, a very reasonable number of trades here. All right, so not a crazy amount. Oil is the one where you sort of expect to be able to, when you get that good day, it'll be really good because it has the most movement. We haven't seen that yet in the last couple weeks. Again, we're just sort of staying in the game at this point. Gold, GCJ9. So gold's down 170 across 2 weeks with trades on 6 of those 10 trading days. It may have been only 9 trading days. And so actually this is one of the things that I've been looking at to make a change. So let's talk about that now, and then we'll switch back to the euro in a moment. I think one of the concerns with gold is that it doesn't quite make the moves that it used to. And so all symbols nonsense. And what we are looking at is we're looking at price action and order flow to find trades. And if there's not enough movement, then there's a relationship between the price action and the chart type. All right, so we use a range bar chart, and we use that because the range bar is a very good way to understand what price is doing, independent of anything else, independent of volume or order flow. And so I use price action, and then separately I use order flow, and that's the data that's given to the machine to find trades. And if there isn't, if your range bar is too high, then much of the price action gets hidden inside that bar. And so one of the things I did this past week was converted the gold chart to a 5-tick chart, and then redid the analysis. And then compared that to what I was doing. So I had a 7-tick range bar chart before. Now I changed it to 5, and then built a model with data through. Let's bring that up. With data through August 17th, and I just want to bring up the screen again. So we trained it on model. On data through, in this case it's now August because the time has gone on through August, and then we take that model that's never seen data beyond August 17th, and we run predictions on the data from August 17th or August 18th through last Friday, and then we analyze that, looking for the behaviors that are that we see more commonly. All right, so that's what we're showing here. So we're looking for trade quality and frequency. In particular, frequency. It's not unusual to see a particular combination of price action and order flow do well once. But what we want to do is we want to see something. We want to see it more than once, and then we analyze. For those behaviors that we see more than once, or 3 or 4 or 5 times, depending on how you've sliced the data. We then want to see, okay, but when it isn't showing up as a good trade, how is it doing? Because you're going to take all those trades, right? So if I'm going to take a turn behavior with a specific order flow, and I see it showing up in 2 of my 6 buckets, that's fine. It's only going to show up in these buckets for analysis if those behaviors were profitable. So the question becomes, well, on these other times, how did it do? All right, and so sometimes what you find is that they only showed up in these 2 buckets. Other times they showed up in these others, and they were okay but not great. In which case you'll keep that behavior in your system. Other times they show up in these other buckets and they did terrible, and so they cancel out. It cancels out the good times. And so I did that with gold with a 5-tick range bar chart, because I wanted to see more price action than I'm getting with the 7-tick. All right, so I redid all that analysis, and what it shows is pretty interesting, because with the 7-tick range bar, my analysis had a risk factor of 14.4% with a profit potential of 463 on a trade quality rating of 1.84, which is not very good. Okay, and then when I go to 5-tick and kind of go through that process of analysis, what I find is I can do a similar level of risk. This is 13.5 risk factor. Here was 14.4. I can do 13.56% of risk and get a much higher profit potential, 813, on a much better trade quality rating, 3.7. Okay, so that looks very encouraging. You can even get less risky if you want, and get a similar profit potential. It's still a little more. This is 463 right there. Here it's 522, taking just a 4.2% risk factor rating. A lot less trades is the difference. So this is 0.8 trades per day on average, whereas with with this higher profit potential number, even with a good, a much better trade quality rating of 3.7. You're at 1.8 trades per day. Okay, so that's what I'm going to be running this week in gold live. I'll bring that in for a week and then release that out to members who are still on the 7-tick range bar right now. Now, the other thing that's going on is the euro. So in the euro, we have a euro chart that we run from during the U.S. cash session. The actual trading times are 5:35 Pacific to 10:40. And you saw those results. We can look at them again real quick. Just kind of nothing to write home about in the last couple of weeks. 6EH9, 5 trades minus $25. Nothing spectacular going on, though the potential is there in the analysis. The thing about the euro is that one of the things that we were interested in was, well, can we trade that during the London session, which starts at midnight Pacific time? And I wasn't finding opportunity via the analysis, and my hypothesis was it was because I have a model that's built for the U.S. cash session where the volume is totally different, so the order flow is completely different during that time. And so what I did is I went off and I built a model that uses just data from the London session, the overnight session, so from midnight Pacific to about 5:30 in the morning Pacific time. And I now have that analyzed and built and set up, and I'm running that in Sim over here in the lower right. This is what this is over here. So that'll start running tonight at midnight, and then we'll see what sort of how it works out. What the analysis shows is pretty interesting. What it shows is here's the normal 6E, and we're using I'm using in production this risk factor, this set 11.86. So this is pretty conservative, 11.86. 20 over here would be the max. This is a little bit more than the max over here. So if there's an obvious dividing line, I kind of give them both to members and let them choose. It ends up depending upon sort of how many markets you're trading. So if you're trading fewer markets, you're willing to take more risk, is kind of the way it works out. If you're trading more markets, you want to take less risk per market, and that way, if they all go against you, you don't get destroyed. The idea with multiple markets being that you can smooth out the amplitude of the highs and lows. So anyway, I'm trading this in the U.S. cash session that has a profit potential of 587 on a trade quality of 4.1, which is very good, risk of 11.86. But in the London session, what I show using that same analysis, so taking 5% risk factor, I show 552. So this was 587, and the London session 552 on equivalent quality ratio, so 3.89. I think 6E was 4.1, yeah. And then 1.2 trades per day, and 6E was also 1.2. So if you trade them both, in theory, that's 2.4 trades per day on a risk that's somewhere between 11 and 5, call that 12%, 12% and 5%. So I'm going to run that in Sim to make sure there's no surprises there. And then if I like what I see, I'll add that to the markets, which it almost becomes like a fifth market. So oil, yen, gold, euro during the U.S. session, and then euro during the London session. It's a little bit trickier to set up because you're running different models for the same symbol. So for members, I'll explain how to make that work. All right, so that's where we stand now. So again, end of week 2 here is plus something here, essentially scratch, plus 140. Okay, this week was a scratch week, basically. We started off the week at, that was the ending value of last week, 130. So this week, 140. So no profit this week. And in net would be a loss because commissions will get you once you factor those in. All right. Okay. So that is it for today. Let's see sort of what the rest of February brings for us, and then we'll make a decision. Ultimately, you can see what's happening is that we're going to end up tuning these risk factor values for the different markets based upon kind of what the results are. I think that it is becoming a personal choice among each trader, but I personally would be inclined to take more risk in oil and then less in the others. But what I'm doing right now is taking all of them at sort of less than 15% risk factors, and then basically I'm playing a defensive game here, and then let's see how that works out. I suspect that it will work out fine. It becomes a question of your level of patience and how I talked about this in one of the videos last week about how well you're able to just let the system do its work and then not look at the charts and go and get upset about having missed a move or having gotten nicked or something bad that happened, and then going and tweaking and turning dials. The whole idea is just let it do its work, and then you don't have to spend any time on it. All right, so that is it for this week, and I'm looking forward to the rest of February here.